investors flocked to the shares of technology firms for most of the last decade. A combination of a booming economy, historically low borrowing rates, and the advent of the digital economy has helped drive up their stock prices. Companies including Amazon, Meta Platforms, Meta, and Netflix, NFLX saw an increase in demand as a result of individuals spending more time at home due to the COVID-19 epidemic. Many of these digital darlings, however, have crashed down to earth as the economy searches for its new normal and the Federal Reserve rapidly hikes interest rates to contain excessive inflation. As of November 1, 2022, the tech-heavy Nasdaq Composite saw the greatest loss, almost 30% of the three main stock market indexes. Even once dominant companies like Meta, Amazon, Alphabet, Google, and Netflix are now in the red. When it comes to tech stocks, should investors see the recent falls as a chance to buy cheap or a portent of trouble ahead? When prices fall and people are gloomy about the near-term future, that's often the perfect moment to invest. You pay a very high price in the stock market for a happy consensus, as famed investor Warren Buffett has observed. The buyer of long-term values may count on uncertainty to be on their side. If you're thinking about buying tech stocks, here's what you need to know. Should conservative investors put money into tech stocks? Some investors may be on the lookout for bargains in light of the recent declines in IT stocks, but it is difficult to say whether or not conditions will worsen more before they improve. According to Liz Yum, SoFi's director of investment strategy, long-term investors may finally start putting money into the IT industry now that stock prices are more appealing than they were a year ago. Because of the uncertainty, she suggests investors averaging gradually in order to take advantage of the lower prices she anticipates in the following weeks and months. There are a lot of obstacles that businesses must overcome right now, such as inflationary wage increases, falling advertising income as the economy worsens, and more scrutiny of their valuations as interest rates rise. Young claims that headwinds are blowing in from every direction for the crew. However, according to Young, investors with a 2-year perspective or longer may begin purchasing tech equities diversifiedly. She suggests an exchange-traded fund, ETF like the Invesco QQQ Trust, QQQ, which mimics the performance of the Nasdaq 100. Why the rise in interest rates is bad for technology stocks. The increase in interest rates has been blamed in part for the decline in technology stock prices. Due to the early stage of development and heavy investment in anticipation of future growth, many technology firms have poor or even negative profitability. In a rising rate environment, investors are less inclined to pay a premium for a company that may or may not produce profitability in the long future and are instead favoring firms that create genuine earnings and cash flow now. Carvana, CVNA, an internet marketplace for pre-owned vehicles that benefited when the pandemic hit and many traditional auto lots shut down, is one such company. Carvana's sales were $3.9 billion in 2019, and they are projected to soar to $12.8 billion by 2021. Unfortunately, the corporation was unable to turn a profit in either 2020 or 2021 despite its meteoric expansion. Strong revenue growth increased investor expectations, and record low lending rates left them a few other options, driving Carvana shares from a low of about $22 in March 2020 to more than $375 in August 2021. The yield on a 2-year U.S. Treasury note has increased from about 0.20% to 4.5% since Carvana's all-time high in August 2021. Carvana's share price has dropped 95% in the same time frame to roughly $15 as of November 1, 2022. Some investors believe the market has unfairly penalized cash cow tech corporations along with shares of more speculative topics, despite the fact that these companies earn tremendous profits right now. Weitz Fund's co-chief investment officers Wally Weitz and Brad Hinton recently wrote in a client note that while higher interest rates are especially hard on fast-growing companies with little in the way of earnings today, several stocks have been punished that do generate earnings and cash flow. Weitz and Hinton noted that many investors appear to have formed the wrong assumption that fast growth itself is a negative in the current environment, but that firms like Alphabet have gobs of profits now and will have much more tomorrow. Alphabet, Meta, and Amazon were all companies in which the Weitz Value Fund had stock as of September 30, 2022.